Hello, everybody. This is Jake Stenziano, host of the Wheelbarrow Profits Podcast, here with my co-host, the multifamily mentor, the coach, the chef, the father of six, the best-selling author, the G-Daddy, Gino Barbaro. Gino, how's it going?
Jake, I'm doing better than I deserve, Jake. I'm on the call today with you two guys, looking to get some energy here, some positive vibes. We got Brian on the call today. I'm excited, bro. How you doing?
Bringing the Panya. As Gino said, today's guest is Brian Burke. Brian is president and CEO of Praxis Capital, a vertically integrated real estate equity firm which seeks underperforming Class B and C multifamily assets. His team brings $6.3 billion worth of multifamily transactional experience, including management of more than 90,000 apartment units. Woo! So without further ado, Brian, welcome to the show.
Thanks for having me, guys.
Hey, that is our pleasure, and let's get this thing kicked off. Tell us a little bit about your real estate background, how you got into real estate, and how you grew your company.
Well, I started out really small, just like anybody else that's new to the business. It started out with one mobile home that I bought with no money down, and kind of grew from there. And and that was when I was 20 years old. So throughout my 20s, I was just flipping houses on the side while working in law enforcement. So, my job was kind of nights and weekends, and then real estate was my daytime gig. So I did that all throughout my 20s, and then in my 30s, kind of moved into a larger flipping business where, after the market collapsed in 2007, we ramped up the business, and we're buying about 100 foreclosed properties a year here in California, fixing them up, reselling them, grew a 100-house or 120-house rental portfolio in the San Francisco Bay Area, which turned out to be a great investment. Wow. And just, over time kind of grew that real estate business just one piece at a time. And, what started with one deal, and now here we are 700 plus later. And, we've moved into larger multifamily properties of, 10 to 20, $30 million price points. And it's been a really exciting run.
So why real estate? I love to ask that question because everyone's got their own different answer.
Well, I took to real estate, at a really young age. I just thought it would be an interesting way to make money. Probably like most people that are getting into real estate, you think that it would be a great way to make money. Little did I know it's not easy. It's something you really have to work hard at. But over the years, what I've come to find is that, everything I've done has been funded with investor dollars from outside investors. And to me, I get great satisfaction from, delivering performance to those investors. And kind of the best example of that was just this weekend. I got an email from one of my investors that we met a couple years ago. And when I met him, he was kind of one of those, really skeptical types that, kind of looks at you through the side of his eyes, wondering how you're gonna rip him off.
Sounds like a good investor.
Yeah, a perfect investor. And we won him over, and it took time, but eventually ended up investing in a number of deals with us. And he sent me an email over the weekend, and he said that there's an exercise that he uses when he does leadership training. He says, think of how many people you know in the world. And for most, that number would be in the hundreds or thousands. And he says, now identify by name the people on that list that when they say that they'll do something, you have 100% confidence that they'll do as they say. He said, most people, including corporate leaders, can count only less than 5. And he said, no one he's ever talked to has had a number approaching 10. And he says, you are now on my list, and very few are. That is the highest compliment I can give you.
That's awesome.
And to be able to do that, to win someone over to where they go from being completely skeptical to being one of the few people on their list that they say they can trust is such an amazing accomplishment. And that's why I do what I do.
Man, I'm starting to write these names down right now. Like, who's on the list? Gino's on the list.
Yeah, right. That's right. That's why we're partners, bro. We're both on our own list. That's a huge difference. When did you get into real estate full time? You transitioned from law enforcement.
Yeah, I started that. Well, let's see. It was about 1997. I started ramping up my business, and I was doing a couple dozen deals a year, and it was around 2001. Where I said, I'm at that stage now where my job is actually costing me more money than, I'm actually earning by being there because of the lost opportunity. So I had to make the transition. So it was around 2001 is when I said, I've got to ramp this up and I've got to grow too. So the way I grew was I put in my 2 weeks notice at the police station, and I said, guys, next week I rented out the room at the community center. I want you all to come and listen to what I'm doing in real estate. And everybody came, and I gave them this little presentation about what I was doing in real estate. And by the end of that meeting, I had commitments for $500,000 from these guys, and I had 28 investors with guns.
Wow, that's awesome. So let me ask you, how did that feel? I mean, you're leaving a job with a pension and benefits and all, and you're transitioning to something that's a huge shift. I mean, you must have had the entrepreneurial mindset already. How did you feel making that leap?
Well, I felt pretty comfortable from the standpoint that I had done pretty well in real estate so far, just before, and I felt good about being able to earn a living. The nervous part was the fact that all my investors had guns. I knew my life was at stake. If I screw this thing up, we're not even going to have this podcast.
That's good pressure to perform right there. I like that.
I call it learning the importance of preservation of capital the hard way.
You hit that 8% preferred return, or you're getting a Glock 23 to the face, pal.
That's pretty much how it goes, yeah.
Now, at 8% preferred, what are you looking for in a deal? I mean, how do you analyze deal? What markets you get into? What's your underwriting on all these type of deals now?
Well, so, now our space is primarily larger multifamily. So, when we're underwriting, we take I call it a top-down, bottom-up approach, and I certainly can't take credit for inventing that term. But essentially what we do, the top-down approach, is first we look for markets that we want to invest in. So, we look at economic reports, studies, demographics. One great resource I use is the Milken Institute's Best Performing Cities Index, which takes into account a multitude of economic factors to kind of rank cities by their performance, and a few other reports that I use to find good markets. So first step is to find a good market that we want to be in. The next step is then to find properties within that market that we'd want to own, and now you're getting into what we call kind of the bottom-up approach, which is where you've got to locate the right submarkets. You've got to underwrite the real estate. You've got to look for value add opportunities. I mean, right now it's really kind of risky to just you do coupon clipper deals. You want to be able to increase the property's value day one. So really it comes down to, first finding your market and then finding your property.
So what's enticing to you about markets? What are you looking for in a specific market?
I'm looking for job growth. I'm looking for population growth, household formation, in-migration, rent growth, favorable vacancy factors, and to some measure a contained amount of new supply. And I know that a lot of people are very, very concerned about new supply, which is a valid concern. But if you have massive population growth, then more important than supply is the construction and absorption ratios. Is that supply getting absorbed by the people that are coming in? So we're looking at all those.
You talked about the supply and demand kind of thing. You're in the B and C space. So what do you think about these A properties? Me and Jake are always batting this around. This supply that's coming online is really tailored to the A minus space. We're in the B minus C space. So do you think that affects your type of investing?
It does, not to an incredible amount. I mean, we have a little bit of insulation because nobody's building a B or C property. But people tend to think that means that no B or C properties are coming into the supply chain, which isn't true, because as properties age, what was once an A property will someday become a B property. That's right.
Really good point.
What is a B property now will someday be a C. So there is supply, but it kind of comes from a different direction. So one thing that limits B class supply right now is that there's very few properties that were built in the 90s. So your B supply is that 80s product typically, right? And but you don't have a lot of 90s products. So it's not until maybe 10 years from now when some of those 2000, 2001 properties start to get a little worn down where those become B supply. So, I don't think that the construction is really a direct competitor, but certainly it affects everything. If A starts to suffer and starts offering concessions, rent reductions, and on, there is eventually a bit of a trickle-down effect that does come into play.
What markets are you invested in currently right now? What cities do you like, and are you in right now?
We own in Dallas, Austin, well, not Austin, we sold Austin, Houston, San Antonio, Texas. So we've been in all the major Texas metros. I've got one property in Arizona, and we're looking for more. I've been best and final on a deal in Atlanta. Atlanta's a new market for me, but not for some of the guys on my team that have done.
Can you talk about Atlanta? Because I've got conflicting reports about Atlanta. There's a sub-market. It's huge. It's risky. You got to know the market. What do you think? What do you think about Atlanta?
I would agree with that. I think you have to know the markets and you have to be in the right area, which kind of goes, with any city you're investing. You could say the same about Houston. We've done really, really well in Houston. And I used to be one of those guys that'd be like, okay, I love Dallas and Austin, but I'll never be in Houston, and then once we figured it out, we've done really well there.
I've heard that from either.
Yeah, I'm sure I'm not. In fact, I heard it from others before I went there. And that was, I was kind of listening to them and they were saying, oh, you don't want to be in Houston. I'd be like, okay, I won't go there, but after a while you figure it out. And I think Atlanta's the same. There's submarkets where you'd want to own and there's submarkets where you don't really want to own. And as long as you get that right, I think you'll do really well. I do think that, from a rent growth perspective, population growth, vacancy, all the economic indicators are pointing to a favorable market there for us to implement our strategy. But again, you still have to pay attention to all the variables.
So you don't think they're in hypersupply yet? You think they're not in the end of the market cycle there?
I don't think so. I think there's still room to go. Yeah.
Okay. And what is your, underwriting criteria as far as cash on cash and cap rates go?
Well, I really don't care about cap rate at all, which may surprise a lot of the listeners. To me, cap rate is an irrelevant measure as it relates to the quality of the investment. I use cap rate for one thing and one thing only, and that's to underwrite my exit. So when I underwrite backwards. The first thing I want to know, and this comes from flipping, right? When you're flipping, you want to know what's the ARV, what's the after repaired value, and then you back into a purchase price. And I've carried that methodology into my multifamily investing, and I'm always looking at the exit first. So I use cap rate to determine, what can I sell for, then I back into, what I can buy for, and what I can buy for has a lot to do with the internal rate of return that I can achieve. So, what I'm underwriting to is I'm underwriting to achieving an IRR net to my investors after any splits and fees that we take to get them at least a 14% internal rate of return. And that's a variable number. I mean, if it's a little riskier deal, that number might need to be higher. If it's like a Class A type deal, it could be a little bit lower. It really just depends on what the market is for our investors. Cash on cash, we typically our offerings have an 8% preferred return. So, my objective would be to hit that, at least by year 2, 3. Before that, doesn't really matter. If the cash on cash is really low year 1, that's a typical value add scenario. That's fine, but we do want to see that cash on cash get close to that 8% preferred really early, because you're accruing. So the longer that you go without hitting that threshold, the longer it takes, for you to meet your hurdle.
How long is your typical hold on a deal?
Well, I'm underwriting everything to a 10-year hold right now. Although our typical hold has been far shorter than that. We've cycled out of some properties in as little as 18 months. But we underwrite everything to 10 years. To me, our business is really about investments and performing and developing a return on invested capital. That's really what it is. It's less about real estate. So to earn a return on capital, and the key thing to do in the beginning is to set up expectation management, is what I call it. So you want your investors to have an expectation going in that this is what this is going to look like. So we set them up on 10-year holds because I think at some point during the hold cycle of any property acquired now, there's going to be an adverse market cycle. And, we want to be able to ensure that we've got the time to go all the way through a market cycle and sell at the next market cycle peak if we have to. So by underwriting to a 10-year hold, the investors are, along for the ride for 10 years if we have to, but if we get out a lot sooner, nobody's ever upset about that.
I've noticed, Jake and I, we haven't syndicated yet, so we've been talking to a lot of investors the last few months. They don't mind that longer time horizon. I always thought they wanted the 3 to 5 year out and boom, done. But when we told them we're long-term, we're all about the cap gains and we're all about the tax benefits, I really got no pushback. I was surprised about that, talking to the investors.
Yeah, you'll find, it's funny when you talk to investors, you get a lot of different stories, right? Everybody has their own set of objectives. So, when we're talking to a new investor, we don't just like throw out an offering to everybody and see who wants to invest. If somebody wants to invest with us, we have to talk to them first. And, they have to call and we have to interview them basically and we give them the opportunity to interview us. And the reason that we do that is, we want to know what their objectives are, and so what we find is there's some people, their objectives are to tie up their capital for as little time as possible. And there are some who say, hey, I don't want to see this money again for a long time. I have nothing else to do with it. I don't mind doing long-term holds. So, we want to make sure that the investor fits the business plan and vice versa. So what we found is that there's a wide range of tolerance with investors and a wide range of goals. And it really just depends on, what their objective is.
What gets you excited about a deal? Everyone talks about these value adds. What do you see when you see a deal? I know Jake starts drooling about certain deals. What gets you going about a deal?
Nothing. Not one thing. I've done 700 and something deals now. When early in my career, I used to get excited about deals, and it used to be, I'm like a kid in a candy store. This is the greatest thing ever. I can buy everything here. And
where okay, hold on, you got to pump the brakes. Where can you buy everything? Because you tell me the place where I can buy everything. I'm going there today. I'm getting on a plane.
Well, I'll do you a favor, and I won't tell you because when you do stuff like that, that's what gets you into trouble. Yep. When you get emotional about a deal and you say, gosh, this is just really exciting. I'll tell you something. I have a pretty good team, and I don't go look at a property personally before we buy it. My team does, and they give me full reports and they tell me everything that's going on. I see everything, but I don't go there. And this is on purpose because as soon as you step foot on a piece of real estate, you become emotionally attached to it. And, you say, well, we could make this work, because this is such a great area. If we just tweak this or pull on that lever, we could make this deal work. And I don't even want that influence. My partners, my team members, they can say, oh, this is a great deal. And they can try to pull on the emotional levers, but all I see are the numbers. And it has to pass my numbers test. So what I get excited about is I get excited about a deal where the numbers, after doing all the homework, meet the hurdles that I need to meet to perform for my investors. That's when I get excited.
He's cold, Gino. He's cold.
I can think he's been burned. We've all been burned. We fall in love with a deal, and I'm selling my house right now. It's residential, and residential market is just ridiculous. I mean, they're looking at comps and this. It's like, give me a break. I mean, you want to live in the house. It's not. It's emotional reasons I'm selling it, but the guy buying, I'm like, give me a break. It's just it is what it is. If you got to replace it, this is what the number is, and I totally agree with you on that point. I mean, it makes so much sense. But I mean, it's specifically as far as value adds. You like to see rent bumps. You like to see additional income. You like to see expense cut. What are you really looking for when you get a deal across your table? What are you focusing in on?
Well, expense cut doesn't excite me that much because, first of all, you can only get a very limited amount of bump off of an expense cut. You can only cut so far, right? So, yeah, you can add a little bit of additional value with expense cut, but in my experience, you don't add a ton of additional value. So that doesn't really get me too excited. But what does get me excited about, the prospects of a value add is I've got to be able to do something to the property, I have to be able to implement some kind of strategy that improves the value. And so that could be where rents are below market and I'm going to bring them to market. That's one. It could be bad management. It's just totally screwing it up, and maybe they aren't keeping the place occupied, or they're not maximizing kind of the occupancy to a maximum amount of rent, kind of fine line that you have to balance. They might not be managing their lease renewals very well, those types of things. So I like to see that. And of course, some kind of physical improvement that you can make, whether it's to upgrade the interiors of the units to where, they meet a higher standard and attract, a better tenant base or attract higher rent, or adding exterior amenities if the property lacks them that cause the property to be more desirable. Now, my preference would be to have all three. Where you can implement physical improvements and bring rents to market and improve the efficiency of the management. Those are the ones where you can score a home run.
How has your investment strategy changed since the last Great Recession, I guess, up until now? What's really changed in your model?
I think the biggest change is the 10-year holds. Doing the longer term stress test, where we want to test the deal's performance on a 3-year exit, a 5-year exit, and a 10-year exit. That's one. Another is just the ultra conservative underwriting to economic vacancy. I went through the 2008 recession after Lehman collapsed and all that stuff happened in late 2008, and saw what happens when the economy starts to tank. It's one thing when real estate takes a hit, but when the economy takes a hit, it's another thing. And I used to hear people say all the time, well, the great thing about residential is everybody has to have some place to live, right? And if you believe that, you're in trouble, because yes, they have to have some place to live, but that place might be their parents' house, their friend's house. It doesn't necessarily mean it's going to be in your apartment. So underwriting to a very conservative, stress-tested economic vacancy was a big one for me, because I know we're going to see that again at some point.
It's got to slow down. We're at 95% occupancy right now. We're at, I think, at an all-time high since the 2001 downturn when we had the big the .com boom. That's how high we are with the occupancy rate right now. So I agree with that. Our students ask this question all the time: where do you find these deals? Where are you finding your deals?
Well, a couple places. I'd say by far my biggest lead source is through brokers. And when you're in the large multifamily space of doing 100 to 400 units and up type properties, there's really a limited number of real players in any market that are selling all the deals there, and they know all the sellers, they have all the leads. That's typically where they come from, through the broker channel. Now, we do have some that we're beginning to source now through relationships. And one thing that I did here recently is we brought some new team members on that we're in the institutional space, working for publicly traded REITs and that sort of thing. And they've got a lot of a deep network where they know the owners directly and can call and say, hey, we want to buy some units in Atlanta. What do you got over there? You guys want to slough off?
Nice.
And we can start to get stuff directly through that channel as well.
I like that. I've heard teams a couple of times in this conversation. You started out as a small guy all by yourself, then really ramped up to 100 units. How have you been able to build your teams over the years?
Yeah, I was the solo operator, and I'll tell you what, if it wasn't for the economic collapse, I'd still be the solo operator. I was happy doing that. It wasn't until 2008 or 9 when the foreclosure situation happened in Northern California, or in all of California, and really across the U.S. When we ramped up business up, it's like I could see this opportunity where I was flipping a couple dozen houses a year, and now my auction calendar, because I would buy at the courthouse steps, and my auction calendar went from 20 houses a week to 200 houses a week to eventually about 700 houses a week on our calendar. It was kind of like drinking from a fire hose, and I knew there's just no way I was going to be able to really capitalize on this tremendous, although relatively short-term opportunity if I wanted to still be the solo guy. So just fortuitously met a partner on the courthouse steps who was a home builder and was kind of getting out of the home building business because he didn't really see any opportunity there for the next few years, and was trying to figure out foreclosures. And I said, well, I've got this figured out. My problem is I can't fix all these houses up. We can buy them, we just can't fix them up. So I partnered with him, and we retooled his home building operation into a home remodeling operation. And that's how we were able to crank out 100 plus flips a year. So that was my first kind of real team approach. And I said, you know what? I can do a lot better if I can bring people in than I can doing this by myself. So, now as I've expanded the multifamily side, it's just been kind of the same thing where, originally I was looking for people that could help grow the multifamily business. And then, over time, people started coming to me, and that's really how it grew, just organically and over time.
I wish I'd asked you this question, but what is the difference between the single family and the multifamily? Which one do you like multifamily better? And is that why you transitioned to it? Is it the scalability of it? And
Well, I like both, but really the single family opportunity, I mean, to do it on a large scale like we were doing in, '08 through 2013 was a limited lifespan opportunity to do at scale. Now all those foreclosures have kind of worked their way through the system. It's back to being, kind of a couple dozen house a year type of business. And I'm still looking for growth. So, multifamily I knew would be a business that could be around for a long time, and really started diving into it a lot heavier in 2010. And, I just knew that it's like, okay, when this house thing is over, what next? Right. So that's what's next. And it's very scalable. And we know we can, we're looking to grow our portfolio to 25,000 units. And, we can do that. But to do that with houses would be a nightmare.
Jake feels the pain, right, Jake?
How many units do you have right now, Brian?
We have just over 1,000 units right now. So we're still kind of in the infancy of our growth.
That's awesome. Let me ask you, last question for me. What is your best real estate investing tip or advice for the listener?
Best tip. Well, I think it's just to never get emotional about a deal and to always underwrite conservatively. I think that's one that a lot of people miss, and I think is probably the most important.
It's not what you buy, it's what you pay, Jake.
Be objective. Stay objective.
Well, you know what? I always say that it's a heck of a lot easier to get into a real estate deal than it is to get out of one. So.
Especially when you overpay, right?
Absolutely.
What on the business side of things? You've been able to grow business. You're over 1,000 units now. Day in and day out, what is your best habit for success that's enabled you to get to this point?
Well, I think that I equate real estate to a meandering stream through a meadow. If you have a flat meadow, a stream will kind of zig and zag and take turns in different directions. And if you're trying to row down that stream and you just row in a straight line, it's 100% guaranteed you'll run aground. So I say that you got to be prepared for bends and turns. You have to be prepared to shift strategies. You have to have an open mind to new ideas and always be learning and looking for better or different ways to do things.
Be flexible. So, yep. Home flipper, multifamily investor, single family, what's been the biggest mistake that you've made in your real estate career?
Probably not listening to my wife when she said I shouldn't do that deal.
Wow, we'll have to get her a copy of this. That was Valentine's Day come late right there.
That's right.
Listen to wifey. Favorite business book, something that maybe helped you with the real estate, or even a real estate book for the listeners.
Gosh, it's been so long since I've read a book. I ran out of time, so I think probably my favorite book is the one that I haven't written yet, but my wife keeps telling me I should. That's probably my favorite one. But I do also like. Here's one. I get a lot of questions from people asking me about a book that will help them figure out the ins and outs of syndicating a deal and raising private money. And a good book that I came across a while back was written by Gene Trowbridge called "It's a Whole New Business." That's a great book that's a little bit off the wall from most. It's not like a motivational book. This is one that teaches you how to raise money.
It's painful. I got one of his other books, and it's about Reg Ds, and all. I'm like, oh man, this is really, it's painful to read, but you got to read it because you got to know it. It's probably got
good content though. At the end of the day,
it's great. No, he's great. He's a great speaker. He's really knowledgeable. He's been doing it for 35 years, or whatever. He was an investor that became a syndication lawyer. But man, let me tell you, it's like watching paint dry.
I think it was like a Sam Frischman book or something I read back in the day, and I was like, did I even retain any of this?
The red cover. You made me buy that
red
book.
cover, man.
Why did I even buy that book, bro? Oh, brutal. It is painful.
I hear you.
Best multifamily deal and why?
I think the best one I've done, well, so far, I bought 2 properties last year, about I think it was 29 or 30 days apart from one another. for combined about $36 million. And I'm selling them now for it'll be just over $49 million, and that's in like 10 months. So I think that's probably my best one so far.
11 unit deal in Buffalo, so you can check out the Bills games. What?
Yeah, I did buy an 11 unit building in Buffalo. It's been a great cash flowing investment, but I don't think anybody's paying me $49 million for that.
You never know. Buffalo Bills. You never know.
Man,
Yeah.
Pagula and the boys, they're going to get the Super Bowl going next year, and the values will go up. When the Bills are rocking, the Buffalo economy is rocking, okay? So you're going to be just fine.
That sounds good to me. I'll take it.
What project are you excited about right now?
No particular project, but I am excited about my new platform. Bringing in some real experienced multifamily guys onto my executive team. We just formed our own management company where we're going to vertically integrate our management on our new acquisitions. I hired a CEO for the management company, and I brought in a chief investment officer, and I brought in a CFO. And these guys bring about 90,000 multifamily units of experience with them. And that to me is extremely exciting because we're going to take Praxis from, what's right now $100 million of assets under management, which is great. But we want to really ramp this up, and this is going to allow me to do that. So that has me really excited right now.
That's awesome.
Scale it up, baby. Scale that business.
Scale it up. That's right.
What's the best way for listeners to get a hold of you?
The best way is through our website. It's praxcap.com. It's praxcap.com. They can call my senior vice president of investor relations directly at 707-703-4500 or through email, which is available on the website. Those are probably the best ways.
That's awesome.
I would say my best takeaway, and it was very comical, was that you're not stepping foot on these properties. Because everything you were saying, I could relate to everything that you were saying, but it's I still, man, that would be very, very hard for me not to step foot on a property because I'm like, I gotta see it. It's the I'm a mentality. I'm gonna do this. I'm gonna do that. I'm gonna do everything. Right? I still got a little bit of that in me, but man, that's pretty good though because you're staying objective and it's all about the numbers. So that's pretty cool. I like that.
It's all about the numbers, and the team is highly experienced, and they go through every single apartment unit. We've gone through that property with an absolute fine-tooth comb, so no stone is being left unturned. But I'm not going to allow myself, because I have the final decision, and I'm not going to allow myself to become emotionally involved in that acquisition.
But Jake, what's really cool about the story? Brian started out as a single guy, solopreneur, single family homes, and now he's ramped up. He's taken his lumps. He's gone through a recession. He's changed his investments. So it doesn't happen overnight. So anybody listening to this, don't think you're going to wake up one day, get into multifamily, within the first 6 months buy a 100-unit deal, and then have 700 units on the contract within 2 years. Normally doesn't happen. You have to learn the business. You have to be conservative. You have to be willing to spend money on your education. You have to be willing to at least get a mentor, if nothing else. Find out what's going on and take your lumps. And you're not just going to wake up one day and say, hey, I'm going to be super successful. You got to put in the time. I know I can tell just from listening to Brian, he's put in his time and he's taken his lumps. And now he's at that inflection point where there's 1,000 units and he's ready to go. So he's had that whole experience behind him, but now he's ready to look forward. So I'm really, really impressed with your story. Thanks for sharing it with me today.
Absolutely. 25 years. You're right. It takes time.
Yeah,
it's definitely funny because I look at when we're about to buy a complex or something, and there's a handful of guys that based on their specific role know more about what we're looking at than I do. But man, that would be tough for me to not step foot on it. Man,
you're killing.
That's crazy. Man.
Jake,
good for you.
Jake, get to 700 and something deal, and you won't feel the same way. Trust me. I felt the same way. We have
over 700 units right now that Gino and I own. It's just I gotta I don't know. I like getting there and kicking the tires, as they say. So
yeah,
hey,
I hear you,
Brian. This has been great. Really appreciate your time. And for the listeners out there, if you found value in the show, please subscribe, give a like, give a review. And hey, maybe a few years from now we'll do this again. So appreciate the time.
Sounds good. I really appreciate you having me. Thanks very much, guys.
Bye, guys.